Hey there, I'm Paul Rabelais here. I'm an estate planning attorney with part 2 out of 3 parts. Who's going to pay your long-term care expenses? So in part 1 and in this part and in the next part, I'll remind you that really there's 3 payors of long-term care expenses. There's the government through its state Medicaid program, there's the insurance company, and then there's people paying it out of their own pocket. Some of the statistics, once someone reaches 65 years old today, they have a 70% chance of needing long-term care services in the future. Once someone reaches 65 today, they have a 20% chance of needing those long-term care services for more than 5 years. So it's a big deal. Those services, what are the cost of those services? Well, in my area, Louisiana, about $5,500 each month, projected over the next 20 years to increase over $10,000 per person per month. Get the idea of a married couple both needing that kind of care, each one having to pay in excess of $10,000 per month. Gets really, really expensive. It's really one of the biggest threats to losing everything that you own. So in part 1 of our three-part series, we talked about how and when the government covers somebody's long-term care expenses through the state Medicaid program. In this part, we're going to focus on when an insurance company covers those expenses. And then in part 3, we'll talk about people paying that out of their own pocket. So really, some people choose to own long-term care insurance. And I have to preface this by saying that so many different companies, so many different types of policies, so many different variables that really in all of these things that we're discussing and these illustrations that it's really not comparing apples to apples. This by no means is any kind of offer or proposal. You really need to look at it yourself, get the good information and get educated, but we got to start somewhere. So to preface that, I'll go over the fact that there are a couple of different kinds of long-term care insurance. There's traditional long-term care insurance, and then there's asset-based long-term care insurance. The first type, traditional long-term care insurance, most people pretty easily understand that. You pay the insurance company every month, every quarter, every year, whatever option you choose, and we'll just talk mainly about annual payments from here on out. But and then if you need long-term care in the future, the insurance company will pay a certain dollar amount for that care. Pretty easy to understand. Traditional long-term care insurance is not unlike the automobile insurance that you have, not unlike the homeowner's insurance that you have. You keep paying those premiums, and if you never have a claim, all those premiums that you paid have just kind of gone away. So many consumers don't like that traditional long-term care insurance because they're just paying in, and never getting any benefit. So insurance companies offer what's called asset-based long-term care insurance. And that's really where, a long-term care insurance is combined with perhaps life insurance or an annuity. And so we'll get to that in a minute. But for purposes of our video here, let's first give you an example of traditional long-term care insurance. Again, everybody wants to focus on cost, but you really have to focus as well, just as important, on the benefits, because so many factors go into the cost for long-term care insurance. Things like your age, whether it's for a single person or a married couple together, your health plays a factor in it. What's called your elimination period, whether you factor in some type of inflation rider. But let's just look at something basic, and got some information. Was working with a couple, husband and wife. They were both 59 years old. That's a really important factor because the younger you are when you look at this stuff, the better the numbers look. Most people don't really start looking at this stuff until they're in their 60s, sometimes in their 70s, and boy, it would have been much better had they started looking much earlier. But in our example, 59-year-old husband and wife, both healthy. They're asking the insurance company to pay for $6,000 of monthly expenses, long-term care expenses, if they get to a point where they can't perform 2 of those 6 activities of daily living. And so they're looking, one option is just to look at a traditional long-term care insurance policy. In fact, this particular policy would pay that $6,000 benefit for, and the way it's written up, 6.9 years, let's just call it 7 years. And so the cost for each spouse to have that coverage, they want to look at it as one payment that would cover both spouses, $6,000 a month for 7 years of payments, and they paid for that long-term care insurance on an annual basis. They would make one annual payment totaling a little bit more than $4,200 per year. That would be for the traditional long-term care insurance, that would pay $6,000 a month for each of them if they needed long-term care. They're 59 years old right now, but if they need care when they're 78 years old, that insurance company would pay that $6,000 monthly benefit, reimburse them for that care for 7 years. So there you have it, just an idea of what that looks like. Next, let's go into the asset-based long-term care insurance policy. And so that's often, long-term care insurance is coupled with a life insurance policy because it's typically funded with one single payment. Typically, cash is used, some type of low yield asset is used, which really looks like, because it does, it results in a kind of a net zero cost. So let me give an example. Same 59-year-old couple wants to get $6,000 per month, but let's say in this example, they want an unlimited benefit. It doesn't stop after 7 years. If they need care for 20 years, it pays for 20 years. So it's an unlimited benefit for each of them. And so now we're looking at a one-time payment, and the way all the numbers shook out for this couple, that one-time payment was a little bit more than $114,000. But what that would do is a couple of different things. If husband and or wife needed care in the future, the insurance company would pay $6,000 per month for each of them, assuming each of them needed care. So it wouldn't be just one $6,000 payment monthly from the insurance company. If they both needed care and couldn't perform those activities of daily living, the insurance company would be paying out $12,000 per month. And so that would go on for an unlimited period of time, not limited to 7 months like the traditional long-term care insurance policy did. But then when you add the life insurance component, this is where it comes into the net zero cost. It doesn't appear that they're just putting money into something that they'll never get back. If they never use the long-term care benefit, let's say, 5, 10, 20, 30 years into the future, they can continue living independently and they both pass away without needing long-term care services. Because they never use the long-term care benefit, the insurance company will pay their beneficiaries after the husband and wife pass away $150,000. If by chance they used just a portion of the $150,000 for their long-term care, let's say they used $100,000 while they were alive for long-term care benefits, then the insurance company would pay the beneficiaries $50,000, the remaining part of that $150,000, when the husband and wife pass away, to the beneficiaries. So look at that again. Couple has some cash. They want to reposition that cash to protect their remaining assets. They reposition a little bit more than $114,000. If they need care in the future, the insurance company will pay for each of them $6,000 for an unlimited period of time. If they don't trigger the long-term care benefit, then the insurance company will pay $150,000 to their beneficiaries when they pass away. So they're going to get that money back in one form or another. They may get a lot more back because if they need care for a long period of time, the insurance company could wind up paying hundreds of thousands of dollars for their care. But they're going to get it at least $150,000 back, either in the form of long-term care benefits or life insurance death benefit. Give you one more example. Let's say same couple, 59, want the $6,000 unlimited benefit, want to have the protection so that if they don't use the benefit, they get the $150,000 death benefit to their beneficiaries. They could take care of that on an annual basis. Instead of putting up one $114,000 payment, they could pay annual payments of a little bit less than $7,000 a year, and that would stop when they started receiving long-term care benefits. So there's many, many different ways to skin the cat, as they say. And every policy needs to be designed to fit your needs and objectives and your lifestyle and what you're trying to accomplish. Key, of course, is planning ahead. Getting this while you're young just looks so much better because it's going to be so much more reasonable and less expensive. And if you wait too long and you get sick or you get injured, then you're not going to qualify for this kind of coverage because there's an underwriting component to it. Who typically takes out long-term care insurance? Well, it's people who, they want to be smart financially and have the insurance in place just like they do for their car insurance and their homeowner's insurance. In fact, they see this as a bit bigger risk because they've never made a claim on their homeowner's insurance, and quite frankly, they're not likely to. But they are likely to need long-term care services in the future. So they want to have that insurance protection in place. They want to protect their assets, but they don't want to rely on Medicaid. They don't want to have a plan that forces them to be in a nursing home. They want to have that long-term care insurance protection so that if they need care, they can have the benefit, but be able to get that care wherever they want it, whether that's in a facility in their home, in a facility of their choosing, perhaps even a child's home. And so they want to have those options to be able to get the kind of care where they want and under circumstances that they can control. So who doesn't get long-term care insurance? Well, again, a lot of people tell me reasons why they don't have it, and there's no right or wrong here. But I hear a lot of stuff like, well, Mama, she just, we took care of her. We took turns going into her home on the weekends. And when she went down fast and she just passed away. If she had long-term care insurance, she never would have used it. So they rationalize that to say that they don't need it because Mama wouldn't have needed it. So, be that as it may, it is what it is. Some people are just don't like insurance. They want to self-insure as many things as they can. So they make that decision to self-insure. And if they never need the care, they'll likely come out ahead. But if they do need the care, they'll probably come out behind. So, but again, everybody has different thoughts and objectives. And so the key here, though, really is plan ahead, get good information, make informed, educated decisions while you're healthy so that this doesn't have to be a nuisance to you or family members and doesn't, deplete everything you've worked for and saved. So there you have it, part 2 of 3 parts. Part 1 was when the government pays for that long-term care through their Medicaid program. Part 2 was when insurance companies cover that expense. And next in part 3, we'll cover when you have to cover that expense out of your own pocket. What does that look like? So hope that helps. I'm Paul Rambolet. Have a great day.